Silver investors, listen carefully. War just flipped into economic warfare. And when that switch gets thrown, most assets trade on opinion. 3 do not. Gold, silver, oil. Everything else is noise, no courses, no signals, no VIP room. This is financial warfare education. Verify everything yourself. Middle East escalation didn't crawl across your screen. It detonated. And while Western futures were closed and commentators were asleep, physical markets were not. Gold and silver traded all weekend. Paper didn't. That gap matters. This is the John OG breakdown. Same board, no filters. $1 segment 1. Escalation, not de-escalation. 2 of Iran's top figures were reportedly eliminated in coordinated strikes. Iranian state outlets framed it as martyrdom. Western analysts assumed regime shock would lead to cooling tensions. Instead, response. Missile volleys, drone swarms, regional targeting. Ballistic launches in triple digits. Dozens intercepted, some not. Civilian infrastructure hit. Ports, energy sites, strategic facilities. Iran publicly signaled there are no red lines. That phrase alone breaks risk models. When doctrine shifts from calibrated response to open escalation, markets don't reprice slowly. They gap. Your metal price is just a translation of that doctrine. Segment 2. Where price discovery actually happened. While Western exchanges were closed, Asia wasn't waiting. Physical gold traded, tokenized gold traded, OTC desks traded, and price moved. Off-exchange markets saw prints near $6,000 per ounce before settling lower, but still materially above Friday's official futures close. Tokenized gold proxies like Pax Gold reflected elevated bids throughout the weekend. Meanwhile, COMEX was frozen. When only one side of the world is allowed to trade, the live market becomes the honest one. That gap, roughly 100 plus over official futures, is not theory. It's liquidity showing its hand when derivatives are asleep. Segment 3. The silver signal, gold whispers. Silver screams. Reports out of Shenzhen showed physical buyback quotes jumping sharply. Dealers bidding aggressively for metal. Here's the important part. Dealers were willing to pay elevated prices, but many refused to sell. That's not a retail coin premium story. That's supply tension at distributor level. Meanwhile, weekend IG silver quotes ran above Friday's close. On-chain derivative venues printed even higher. Shanghai premiums widened relative to COMEX. When the physical market bids above paper and refuses to release inventory, you're not looking at hype. You're looking at structure. Segment 4. The 3 assets that trade on necessity. When systems destabilize, capital reprices toward what cannot be printed. Gold, monetary reset hedge. Central banks accumulate gold when trust in the monetary framework weakens, not because of inflation headlines, because of system risk. Silver, industrial. Plus monetary hybrid solar, EVs, AI infrastructure, defense electronics, medical tech. Silver isn't optional in modern industry. It also carries thousands of years of monetary memory. That dual demand matters during conflict. Oil, energy, lifeblood. Oil isn't an asset class. It's the bloodstream of global logistics. You can print currency. You cannot print barrels. When all 3 spike together, that isn't speculation. That's necessity repricing. Segment 5, the Strait of Hormuz reality. The Strait of Hormuz handles roughly 1/5 of global seaborne oil trade. On paper, open. In practice, constrained. Why? Insurance. War risk premiums jumped sharply. Tankers hesitated. Some anchored. Some rerouted. When insurance pricing spikes, shipping pauses before politicians speak. That's how energy flows freeze without an official blockade. And when oil supply risk rises, gold and silver don't ignore it. They anticipate the monetary reaction to it. Segment 6. Economic warfare. Targets infrastructure. Recent strikes and threats extended beyond ships, ports, storage, logistics corridors. Ports are harder to defend than vessels. They're fixed targets, hit infrastructure, and you don't just disrupt shipments. You raise the global cost of trade, higher insurance, higher freight, higher energy input costs. That flows directly into currency pressure and sovereign risk. Markets reprice that fast. Jerkster segment 7. Who feels it first? Major Asian importers rely heavily on Gulf energy flows. Energy shock equals currency pressure, inflation stress, growth headwinds. When fuel costs surge, nations often increase hard asset hedging. Gold buying intensifies. Silver demand doesn't disappear. Energy importers historically turn toward metals during instability, not away from them. Ashrigs, segment 8. The honest bear case. Weekend pricing can exaggerate gaps. Liquidity is thinner. Arbitrage desks are slower. Emotion trades harder. When futures reopen, gaps can partially fill, spikes can retrace, paper pressure can appear,